Okay, so we just went over cash versus accrual. The majority of the taxpayers use cash accounting. Some places where you cannot use cash accounting, where you have to use accrual, normally have to do with inventory. If you're dealing with inventory, then normally you have to report on an accrual basis of some kind. But the majority of taxpayers going to use accrual basis. Cash basis. So you get paid cash. That's normally when you have to pay tax on it. The problem with cash basis or accrual basis is that you might have to pay tax on income you haven't been paid for yet. So you run into that dilemma. It's like, well, I had to report this income and I owe tax on it, but I haven't been paid yet, so I don't have any cash to pay the tax with. Okay, so that's why the government lets you use cash accountant and cash basis accounting for taxation. A lot of CPAs out there in the profession actually fight to keep that, because sometimes the government is actually threatened to take away cash basis because of how you can manipulate it by timing when you pay expenses from tax year to tax year to manipulate the earnings on the tax return. Okay, lovely. Okay, the first thing they talk about is interest income. In general, you get taxed on the interest as you receive the payments. The exception to that is we have these savings bonds. So those don't give you periodic interest. Okay, regular interest income like interest-bearing deposits, okay, they periodically pay you the actual interest earned on those accounts. So they pay you every month. Okay, with savings bonds, there's actually just an increase in value. So maybe the savings bond was purchased for $100, and let's say that's 2010, and then in 2018, when we sell, dispose / it matures, and maybe it went up to $150. Okay, so that increase in value of $50, well, we can choose, we actually have a choice in this matter. We actually can report the gradual increase from year to year. Or we can wait until it actually matures to report the income. So we kind of have a choice. So they let you kind of choose between whether you want to do accrual or cash only for that particular type of income. Alright, next thing is dividend income. Same as interest. So dividends get taxed as you receive them. Alright. One thing I did want to mention is that they're speaking specifically to cash dividends. Okay, but remember, you can pay stock dividends in a corporation. And just to refresh with the accounting equation, assets equals stockholders, liability plus stockholders' equity. Stockholders' equity in a corporation consists of capital stock and retained earnings. Retained earnings is net income, your profit you made that year, minus your dividends, and then your dividend or your net income is made up of revenues minus expenses. So that's a corporation. Now, if you get a dividend that's cash, so if we just say cash dividends, all right, so if cash dividends increase, well, that's going to decrease our retained earnings and also decrease our assets. If we get a stock dividend, well, you can see, all right, kind of like the cash dividend, it's going to decrease retained earnings, but it doesn't affect assets, nor does it affect liabilities. It actually goes into capital stock. Okay, so it's basically from one equity account to the other. So in general, stock dividends, because there's no property exchange, so to speak, it's not taxable. The only way it gets taxed is if the shareholder, instead of getting stock, additional shares of stock, if they can choose something else. Like say, well, instead of this stock, I want you to, give me some money, or other property. So even if they don't choose it, if they have the option to choose something other than stock, it automatically makes a stock dividend taxable. Okay, but only if they opt to receive something. Both have the option, even if they don't opt for that option, they still have to pay tax on those dividends. Also, if they're not pro rata, that means they change ownership in the corporation. So everything that's distributed has to be distributed proportionately. So, so there. Okay. That was fun. Now we move on to the taxation of dividends. And I'm specifically going to talk about qualified dividends. So qualified dividends are basically taxed at more favorable rates. So if you are in the bottom two tax brackets, so just using the old tax brackets that I presented in your text, if you're in the 10% or the 15% tax bracket, like for your regular income, you are taxed on qualified dividends at 0%. And if you are in any of the middle brackets, like say everything except for the bottom two and the top, your qualified dividends are taxed at 15%. And then if you're in the top bracket, so the top bracket in 2017 was 39.6%. Well, on qualified dividends, you only pay 20% on those. So they have more favorable tax rates, and basically those were instituted under Bush Jr. during his administration to alleviate some of the double taxation of corporations. Because remember, one of the troubles in paradise when you have limited liability protection from a C Corp is that, well, there's double taxation. So the C Corp is going to pay tax, and then the person receiving any distributions of profits are going to then pay tax on that same income again. So this mitigates that double taxation somewhat. The general requirements for qualified dividends is you just have to hold them for a couple of months, so you can't be buying the stock and selling out of it all the time just to make sure you get these more favorable tax rates. So they have a holding period, generally about 2 months during a certain period of time. Okay, so how are we doing on time? No, only 10 minutes. Look, we can keep going. All right, state and local tax refunds. We don't really have this in Texas. So a state refund, what would basically happen, if your state has income tax, then you have to file a state income tax return in that state. Even if you don't live there, sometimes if you're just doing some temporary work there, or if you operate in multiple states with your company, just for the business you have there, you still incur an income tax and you end up having to pay and file a state return. Now, a state refund, because you're allowed to deduct, so we'll talk about that later, you're allowed to deduct state income tax on your federal income tax return. So if you have income tax you had to pay to Colorado, the IRS says, all right, you know, that tax you paid to Colorado, well, you can go ahead and deduct it. But later on, if you get a refund from Colorado, because you took a deduction for the tax you paid, if you get any of that back in a refund, the government wants you to pay tax on that because you took a deduction for it. If you get any of that back, they want you to treat that as income. So it's like the deduction's coming back in reverse and become an income. And you normally get a form that I think they give you a 1099-G or a W-2G. I want to say, I can't remember, I have to look it up. But I've seen the form a few times. It's eluding me at the moment. In real life, I've seen the form in real life. Okay. Oh, there it is. It's a 1099-G. It's right there in the text. Ho ho! I knew it was something G. It's a W-2G. That's where gambling. If you get gambling from a casino, you get a W-2G. I just got my G's mixed. All right. So then we move on to some magic. The unemployment compensation. So you get a T99G for that. 1099G for that. And you have to pay tax on unemployment. There was a short period of time as a part of a stimulus measure where they didn't tax like the first 2,000 of unemployment or some crazy crap like that. You don't have to know that, but just little known fact. But now they tax the whole thing, and they normally always have done that. And at least in recent history, in my lifetime. The Social Security benefits. Now they have this awesome formula that you do not have to memorize. Okay, Social Security. Sometimes it's called WASD. WASD. What is WASD? WASD. So WASD stands for Old Age, Survivor, Disability, Insurance. So old age is basically, it's supposed to be your retirement on some level. They always have this gloom and doom in the news that, oh, it won't be there. And maybe it won't. I don't know. But old age is supposed to supplement your income in retirement. Survivor, that's if your parents die when you're real young. You get a survivorship benefit until you're 18 or something like that. And then disability, of course, if you're disabled, you can collect out of the fund. And then insurance is just, well, everybody's paying into it to share the risk and to share what gets paid out to the folks who qualify for benefits. But yeah, don't worry about that formula. I think there might be a homework problem where you have to calculate something, a taxable portion of Social Security benefits. The only thing I really want you to know is that you can be taxed on 0% of your Social Security benefits, or you can be taxed up to 85%. Okay, now, if you get these benefits and you don't have any other sources of income, the government's not going to touch it. They're not going to take any cut of it. But if you, like, say, retire and you're collecting Social Security, and then you're like, you know what, golf is stupid, I'm going back to work, and you end up making some buku money, well, the government then wants a cut of your Social Security. So the higher your income that you're earning while you collect Social Security, the more of a cut the IRS is going to take. But they will never take more than 85%. So you always have that last 15% that's protected, quote unquote. But, you know, even if they tax you on it, that means you're still only going to pay like a percentage to the government in tax. So these percentages I'm giving you here, those percentages are just what amount is going to be subject to tax. Okay, so what amount is the government going to tax you on? Not that they're going to take 85% of it. Okay. Moving right along, and I hope we will. They give you some miscellaneous sundry items. So jury duty pay, taxable. Prizes and awards, taxable. There are some exceptions, I think, to prizes and awards where, like, if you didn't ask for it, or you don't keep the prize, you give it away. Some stuff like that. But generally, just know that prizes and awards, you got to pay taxes on them. So your lottery winnings, bingo winnings, If you enter a beauty contest and you win, you got to pay tax on it. If you're forgiven any debt, like if any debt forgiveness, that's treated like income. I think there's some exceptions here and there, like certain forgiveness programs for certain services, and I think certain types of housing debt at times have been excluded from taxation during like the real estate crisis we had a few years ago. I think they had some relief where they weren't taxing you on debt relief in some of those cases. Certain insurance proceeds, and generally, well, I'll just tell you. Oh no, what am I doing? Insurance. Generally, any insurance proceeds are taxable except for life insurance. So if you have a life insurance policy and you die, and your family gets the proceeds from your policy, like $1 million, well, that's completely tax-free. The government cannot touch that. So that you can always hear these stories about people murdering their spouses or their loved ones, or murdering their parents so they can collect the life insurance that they got wind of. So it's a very attractive, very tempting thing. And then I think their personal injury. And when I say personal, I want to say physical. Okay, so if somebody hurt your feelings, then that's not going to count as physical. But if your finger got cut off in a factory, all right, that's a physical injury. So if you get compensated due to the value of the finger, then normally you're not going to pay tax on that. But if it's just that somebody hurt your feelings because they said your name on social media and said something bad about you, and then you sue them for millions of dollars, well, that's punitive. That's always taxable. All right, I think we can keep going. I want to see. Okay, so this is the last section anyway. I think we should keep going. Non-taxable employee fringe benefits. Now this is kind of fun. This is a lot of fun. No additional cost services. So airlines. So let's say the airlines have empty seats. And they're like, well, if we gave those seats away to our employees, it wouldn't cost us anything extra. So we don't have any customers filling those seats. Now, if we have to displace a customer, if we have to, tell a customer to get up or drag them off the plane like we've seen in the news in a case, then, yeah, those become taxable benefits if an employee's taking those seats that we're displacing paying customers for. But if there were empty seats and nobody who's a paying customer comes to buy them, then it's a no additional cost for us to just let employees take those seats as one of their benefits. Same thing with discounts, so long as it's within a certain range, they can give reduced rates on like hotel rooms, stuff like that, or on products. Working condition fringes. So let me see this for a minute. Okay, yeah. So let's say you have to use a company vehicle, and the employer wants you to use a company vehicle because it has their logo and brands and stuff on it, and they don't want you driving around in something that doesn't have the company name on it. So they give you a company car, you drive around in it, and so that's tax-free to you. The company's taking all the expense for it, but it's for their convenience that you're driving it, not because they're trying to be nice. Transportation fringes, so if you get like some parking benefits, other things like that, van pool, those are tax-free to a certain amount, not like unlimited. Moving expense reimbursements. So your company, if you move between cities, they might give you a moving allowance. So that's tax-free. So as long as it's accountable, which basically means that what you're going to do you're going to move your effects and incur expenses, and then you're going to submit a report of those expenses with supporting documentation to the employer, and then any money they pay you in reimbursement won't get taxed. And then de minimis benefits, so those are like in the supply cabinet when you walk home with some pens and pencils and notepads from the supply cabinet. Those are very, very nominally cost items. No one's going to miss them. The corporation, they won't care. Those would be tax-free. And then, if you use a copier or you use the computer, the company computer to buy airline tickets or something for personal, then I guess that's de minimis. It's too hard to track. So there. All right, they say some stuff about employer-provided benefits. So like health insurance provided by your employer normally is going to be a tax-free benefit. If they give you educational assistance, like to go to school while you work, that is also tax-free. And group life insurance, no more than $50,000 of coverage. And I think that is it. So other non-taxable items, scholarships. Now notice it's scholarships, but not for housing, not for room and board. Okay, so not for room and board. If it's for tuition and fees and things like that, and even textbooks, okay, well that portion of the scholarship is tax-free. But if they have any excess left over that they're using for their housing and their food, then that portion is going to be taxable. So what you'll normally get from the institution is a 1098-T, and that form a lot of times will have an amount of scholarships, and then that would also have an amount that was paid for tuition and fees. So you use that form in conjunction with maybe some receipts that show book purchases, and that should provide substantiation for the tax return. That you don't get taxed on any of the scholarship. Qualified tuition program withdrawals. So tax-free savings accounts. We'll talk more about those later, but basically 2 examples of tax-free tuition withdrawals. There is this thing called a ESA, Coverdell Educational Savings Account. And then they've also got 529 plans. So both of those are with post-tax dollars, and they both grow tax-free. So anything that you take out of there that's used on education, used on qualifying education, normally higher education. So that's changing a little bit. I think Trump's tax reform that just came out, you can actually start using this 529 plan for private school, like high school, things like that. So that's something new, but in general in the past it's only been you could take funds out, spend on higher education, and then you won't pay any tax on that. If you don't spend it on higher education, then you get a penalty of like 10% of whatever you take out. Okay, life insurance proceeds, I talked about those already. Gifts and inheritance. Okay, so a gift and inheritance is paid by the donor or the estate. So the donor is whoever gives you the gift. Okay, so they're the ones who pay any applicable taxes on the transfer, but it's not an income tax. And when the transfer gets to you, the gift, then you're not taxed on it. Okay, that's tax-free, gifts and inheritances. An estate is when somebody dies, basically everything they leave behind, that's their estate. So if the estate pays you, also you'd have to take into account that the estate has already paid the tax on the gift, so it's tax-free to you as an heir. Right, compensation for sickness or injury. We talked about that already earlier. And then child support is tax-free as well. Public assistance, such as welfare, that's tax-free. And then I think we're done. Thank you very much for your attention. I hope you're having a great weekend so far.